to show you when the stock market will crash. I'm going to show you when the stock market will crash with a high degree of certainty that you should be able to jump to or arrive at that conclusion, not jump. We don't want to ever jump to conclusions, but you should be able to arrive at that conclusion pretty confidently. And we're going to look at three different charts. To the left, I have the Shiller PE ratio. I have the Dow to Gold ratio. Then we'll look at just the overall Dow, just the whole, 100-year history, not the whole 100-year history, but just 100 years, past 100-year history, historical chart of that information. The more charts or the more data you have in forecasting helps you increase your confidence level to a high number with that forecasting. This method I've chose based on prior years or prior periods show 100% case of determining when the stock market will crash based on these elements or based on these numbers, which I'll show you 100% of the time. And we can also kind of gauge a degree or the extent of the crash that will occur with these charts. So we'll determine when the stock market will crash and when it will begin its crash. Why do I have three charts? More data, the better you are. So let's say a weather forecaster or meteorologist, when they're forecasting the weather, if they know one piece of data, the temperature, let's say, that's not enough. They know that with the temperature alone, let's say if it's 100 degrees, they know it's just a hot day. That's all that temperature by itself tells you. Now, if it's 100 degrees in December, now you have more data. If it's 100 degrees and high humidity with a cold or with a hot front or warm front or cold front or weather, let's say a hurricane approaching, 100-degree humidity and a 100-degree day in terms of the temperature, you know with a high degree of certainty that there's some type of storm. You have all those conditions with the cold front approaching. Now the temperature changed to 20 degrees and a bunch of, let's say a tropical storm is approaching, from the Caribbean somewhere, and you're located in, let's say, the New York area, you know with a high degree of certainty that a snowstorm is approaching. So each element is great, by itself, but it's even better in conjunction with others. And the more you have, the better you are in determining when and the level of degree of certainty. Because, of course, you have a bunch of water or a bunch of moisture. That's a difference of 1 inch of snow versus 20 inches of snow, or 1 inch of rain versus 16 inches of rain. Or I don't know if it's ever 16 inches of rain, but possibly, spread if it's a storm that occurs over multiple days. But let's get into the data. Dow Jones right now, we'll look at the charts from right to left. Dow Jones right now, 100 years, inflation adjusted, we're at an all-time high. We're at about 26,000. You take off inflation adjusted, we're still, of course, at an all-time high, 27,000. Dow to gold ratio, this is the 100-year historical chart, it's 100 years as well. Dow to gold is basically the price of the Dow, which is here, divided by 1 ounce of gold. 1 ounce of gold, I think right now is about $12.50. So you take that 26,000 divided by $12.50, and you should get to about 21 around there. If you take those two numbers, Dow to gold ratio, it basically lets you know how much currency is in the economy based on the price of money. Now, you can call gold money, oil money. It has to be like some type of commodity or something that's in limited supply. And this also tells you how neglected commodities are. So the higher the number, the more neglected commodities are in comparison to all the currency that's in the economy. And the Dow is just used as a gauge to determine all the money that's in the economy, or in this case is in the market. And the funny thing is about the market, the money never stays in the market. It flows in. As you can see here, when you look at inflation adjusted, the money flows in. When it goes up, it flows into the stocks, out of the stocks, into the stocks, out, in, out, in. So right now you can see a lot of money's been printed. We're not even going to look at the M2 money supply, but just know, a lot of money's been printed or increased money supply, and it's went into this Dow, which if there's a crash, we can expect this money to come out. And of course, when it comes out, typically goes to commodities because the money has to go somewhere. And of course, people aren't buying stocks. So price or inflation typically occurs. And this last chart here, Shiller PE ratio, this is basically how expensive the stock market is. I think this may be the S&P. S&P Dow pretty much, pretty close, gauges or pretty close charts. So the higher this is, so basically it's the price of stocks divided by the earnings or the profit, net income of stocks. So the higher this is, the more expensive stocks are. The lower this is, the cheaper stocks are. Higher this is, some more violent or increased probability that stocks will decrease. Lower this is because they can't grow to the sky. That's a saying, do trees grow to the sky? And the lower this is, the more potential it has. So let's say this is a 90-year-old man, you can't expect to live long. Well, let's just say 110, because advances in science has people living longer. But, this person is 110 here. You can't expect to live long. Whereas here, this is a 5-year-old. You have a lot of life in front of you. Here, it's just science. You can't expect to live long. You're not going to want to, start saving for retirement when you're 90. But when you're 5, of course, you don't have the intellect to save for retirement. But if you did, you'd be far greater, far richer, far wealthier. So we'll look at these two in conjunction. Now, the first thing you can see, well, you probably can't see, because if you did, you would have made the video. But the first thing we'll see is that when this ratio gets to 18, when both ratios get past 18 and 20, things get a little funny. Crashes typically occur. So let's see the first point that both ratios were above 18 to 20. So we have the Shiller PE ratio. So stocks were very cheap in 1920 and they got very expensive. So let's look at the Dow Jones just to see on that particular time, 1920. So the stock market, of course, this is inflation adjusted, keep in mind. So, this is the real, but this is inflation adjusted. But the percentages should be fairly close. 1920 stock market 900 went to 5,000. So what's that? What did I say? 900? Is that what I said? I forgot already. Yeah. So let's say 1,000. So you got 5 times. 5 times your investment, 4 or 5 times your investment. You turn 1,000 into 5,000, 100,000 into 500,000, which is great returns in 10 years. 1 million, 5 million. And that's just with the general stock market, let alone individual stocks. I'm pretty sure I know that they far outperform that 500, that 5 times gain. You may have got 20, 15 times if you were prudent and keen on knowing the investment basics. But that's neither here nor there. That's a different video. Here you have 20, above 20, let's say 1927, above 1820. And let's look at this Dow Gold. So you could still been in the stock market here. And look at this fast, rapid increase. You have 18, and I can't get the exact point. Let's see if I can get the exact point. Okay, here we are, better data. So you have 18. In 1929, you had maybe July, you had 18. So this was a volatile decrease because it didn't linger above 18. It hit 18, then it proceeded to decline very fast. So here, both charts above 1820, 1929, you had the Great Depression. Let's see the extent of the decrease, inflation adjusted. So it went from 5,000 to 800. So you're looking at a 90% decrease, about, 85, 90. You're looking at a 90% decrease when both charts reached that key level. Okay. So keep that number, as a mental note, 90%. And that was within 1 year. Actually, that was in a few months. You reached the high, and I've said few, maybe 2 months where you reached that high and there was a rapid decrease. Okay, so let's look at the next point. Next point we have, this is below. Next point we have 1937. We have 20 here. Let's see if the Dow Gold ratio. See what we're looking at. We're looking at 5. So you can't expect a real crash, even though if there was one, you had no way of determining that because it was just one indicator. It was just one indicator. But let's see where the stocks went in 1937. So there was a crash. 1937 went from about 3,000 to 2,000. So what's that, about a 40%, 30% crash, but we would have missed that one there. And keep in mind that, we would have saved so much from pulling out of the market here that, even that 40% decline, because we probably would have got back in at this level, so we would have made great returns, especially, keeping that 500% there. Let's look at the next point that it was above 20. Here we have, this is about 1963, got to 20. Let's look at this chart. Okay, so looks like both above 20, both above 18. And let's see when the stock market reached its peak. 1966. So 3 years. So, 1929, we're looking at about 2 months. Let's say, zero. We'll call that 0 to 3 years. So within 3 years so far, we're looking at a crash every time both charts hit 19 and 20. And let's look at the extent of the crash. So it went from about 8,000 to 2,000. So the prior 1929 was about 90%. This is about 80%. So we're looking at severe crashes when both of these numbers reach that high level. And as I mentioned earlier about the weather, you're looking at severe climatic events in those conditions where you have the high humidity storm, or where you have the high humidity and a warm front approaching, or a tropical storm carrying moisture approaching, and extreme temperatures, 100 degrees or 20 degrees, 10 degrees, whatever. So that was 1960. So let's look at the next point on a Shiller PE where we get above 20. Okay, here we are, 1929. Okay, we're at 20. Let's see where we are here. What did I say? 92. So we're at 8 here, 9. So we're not going to sell, really make any changes. And let's see if the stock market did anything. It went up. So if we would have sold, based on the 1937 instance, we would have lost money in this case. That's why I really don't recommend, because that's not a severe, even if, history shows, even if it's a severe decrease, it typically goes right back. Let's look at the non-inflation. It typically goes right back. Went from, 170, you're right back 140, 120. You're not really at a true loss. And then you proceeded to make monumental gains. So that's why we only look at when they're both above 20. So getting back to 92. Let's put on inflation, adjust it. Let's get back to 92. So you still continue to get gains. So let's look here, see when it. Okay, so it stayed above 20 ratio from 1992 to 1999. So we just have to determine based on this chart when it hit 20, and we know that we should begin to sell. Let's see. Look at that. I'll change this. Yeah, since we'll only be in the future from this point forward. So here we are. So 1997 about. So let's see when the stock market hit its peak based on the prior data. Prior years where we know within 3 years. So let's see if it held true in the 2000s. Okay, 97. Oh, here's a peak. What year is this? Is it within 3? Look at that, 2000. So within 3 years so far, 100% of the time, stock market peaks out and starts a decline. So let's look at the extent of this decline. Went from the 16,000 to 8,000. So you're looking at a 50%. So keep in mind, 1929, 90%, 60s, 80%, and 50%. So that average, what's that average? Maybe 80%, 70%, probably about 70%. So we know so far that there's a 70% decline when these ratios both hit about 18 to 20, and it's been true every time in the past 100 years. And let's look to determine, see where we are now, just to see when the stock market will crash. Okay, so remember 20 here, 19 here. Okay, so we see we reached that level 2010. Let's look at this level, 2010. Look at that, 7. So sorry about that. My computer actually crashed. Much like the market is set to crash. But where was I? So I yeah. So here we were 20 on the other. We were 8 here. So let's see if there was a crash, which we know that there wasn't a crash. So let's see. Look, stocks went up. This is why that 1937 instance. Once again, you can't. Both numbers have to be above 20. And let's look to see where we are now. So we know we stayed above 20 here. So let's see when we hit 18 to 20 based on this Dow to gold ratio. Because remember, we have to have both numbers. Okay. So 2018, we hit 19. And look at that. 2018, we hit 22. So we have both numbers. When both numbers are above 18 and 20, a bell should ring. Ding, 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 ding. A mental bell. Ding, ding, ding. You have to start selling. So within 3 years of the end of 2018, right now is May. We're in the month of May 2019. So we would have 3 years from into 2018. So we're looking at the end of 2021 where we can expect a high in the market, then a subsequent decrease. We don't know how long the decrease we don't know how long. Let's go here. We don't know to what extent. Well, we do know to the extent, but we don't know how long of a decrease we can expect. So, for instance, 1929, it was a fast from high to low, bottomed out within maybe 1 year, 3 years. I can't even get there. Yeah, so bottom out within 3 years. But I mean, even from here to here, that's a bottom to me. So 2 years. So bottomed out within 3 years, whereas 1966, it didn't truly bottom out until what's that? That's 16 years. So it took 16 years, which, depending on your age, that's a very long time. But there are other alternatives that increase in value in those conditions, and I have those listed in other videos. But you're looking at a 16-year time frame here. And from 2099, you're looking at an 8-year, 9-year time frame. So we don't know if this is going to be quick, within 3 or within 16 years maximum. But we do know the extent, as I mentioned, the average crash is about 70%, when these two conditions meet. So you're looking at a 70% crash, either through an increase of currency, which I think is going to be the case, or you're looking at a 70% crash where currency pretty much stays the same level, but you have problems like Social Security, pension problems, where if there's a crash, and the currency stays the same level, I mean, you're going to be looking at conditions worse than the Great Depression. However, if the inflation is increased by, let's say, devaluation of the dollar or these basic income type of principles, where the monetary value of the stock market, let's say within by 2030, if the stock market is 26,000, however, you increase the liquidity so much where its real estate is tripled and all these other asset prices have tripled, gasoline, oil prices have, went up 5 times, whatever. It's not felt as much by the average American. And keep in mind, the average American is oblivious to inflation. So they may not, when you look at their 401k or the value of their assets, they may not even notice that there's a real change, because they'll look at it and say, oh, the Dow's still 26,000. It just hasn't went anywhere. When, in the 60s, if you take off the inflation, 60 to 80, the Dow hit 900 1965, and it was still 900 1982. So average oblivious American could have said, oh, I didn't lose any money because it's still the same. However, if you put on inflation and you look at the increase in currency from those periods, I mean, you had I think that was a 70% or the 80% decrease. So you definitely lost money because you lost purchasing or buying power So what do you think about the data? Do you think this is a good determination where you can arrive at a conclusion that states that the market will crash within 3 years or will begin to crash? Let me know. 100% of the time, I found it is true. Let me know your thoughts below. Comment on the video. So keep in mind we have until 2021. The good thing about these videos is that we will be able to determine. Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.